Okay, Julius, if you could please start the live streaming. And I think we should be good to go.
Good morning. Today is Thursday, July 14th, and I'm calling this meeting of the Tax Expenditure Review Commission to order. To start with, we're just going to take the roll to determine who's present. Ms. Ho, will you go ahead and take the roll, please?
Thank you. I'm going to hold just for a second. There's an issue with the live streaming, so we're going to try and fix that before we continue. Oh, okay, got it. Looks good there. Okay, thank you so much.
No
Members, please unmute yourself for the roll. Chair Gomez.
Gomez, present.
Senator Rest.
Here.
Representative Davids. Senator Weber.
Here.
Representative Schultz.
Present.
Representative Hertaus.
Hertaus present.
Senator Dietzick. Commissioner Doty. Senator Bach. Representative Marquardt.
Present.
And Senator Nelson. Oh, there's Commissioner Doty is joining us right now. So I'm counting Commissioner Doty as present. And that means we do have a quorum, Chair Gomez.
Thank you so much, Ms. Ho. Since we have a quorum, we're going to review and adopt the minutes from the April 19th meeting. Do we have a motion to adopt the minutes from April 19th, 2022?
So moved.
Second.
All right, all those in favor, please say aye.
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 Any opposed?
Aye.
Please say no. All right, the motion prevails and the minutes for April 19th, 2022 are adopted. So I'm just want to thank everybody for being here as we're really starting to move into the meat of the work of this commission. Our idea was sort of that we wanted to be able, I know that some of us have some background in tax expenditure budgets, some of us don't. We also want this to be useful to anybody following along at home. And so just to start with, as we move into, our large task in front of us, which is reviewing, the effectiveness of the tax expenditures that we have in our statutes right now. We're going to hear first from Mr. Eric Willett from the Minnesota Department of Revenue, the Office of Tax Research, to provide us with a brief overview of the tax expenditure budget report, which of course comes out every 2 years. And after that, we're going to hear from Dr. Laura Kolumbakidis. I'm sorry if I hope I got your name close to right, who is a state economist and co-author of the 2011 Tax Expenditure Review Report. And sort of one of the recommendations that came out of this report that Dr. Kolumbakidis and others worked on for us in 2011 was, to establish this commission. And so we're just interested in hearing more about that study and sort of if she or her colleagues have advice for us as we're moving forward in implementing the recommendations from this study. So without further ado, I think we're gonna ask Mr. Willett to unmute himself. Welcome to the commission. Please state your name for the record, and then you can go ahead with your presentation. And just if members have questions, do you want them to like hold them till the end, or do you want to stop your presentation? It's up to you.
Madam Chair, either way works fine.
Okay,
So if
Yeah.
people have questions, they can jump in.
great.
Thank you, Madam Chair, members of the commission. My name is Eric Willett. I'm the Director of Tax Research at the Minnesota Department of Revenue. My team puts together the biennial tax expenditure budget, and I will be doing an abbreviated version of the report that the presentation that I did to both the Senate and House tax committees this past session. Okay, I think, can you see the slideshow? Great.
That looks good. Thank you.
Okay, the tax expenditure budget is something that the Department of Revenue prepares every 2 years for the legislature and the public. The one we released this past January is the 18th tax expenditure budget done by the tax research team, required by Minnesota statutes 270C11. The first report was in 1985. Part of the law that established the Tax Expenditure Review Commission also changed the timing of the report. So the next report will be due November 1 of 2024 and every 2 years thereafter. And the idea with the timing change was so that you would have a fresh tax expenditure budget when you're headed into a budget setting legislative session. So you can consider tax expenditures and direct expenditures at the same time. This is a major project for the department. It includes estimates for over 300 separate items across 15 tax types. So what I'd like to do today with the brief time that I have is to briefly talk about the concept of a tax expenditure and how we define tax expenditures for the purposes of the report that we do, including a discussion of what we use as the reference tax base for some of the major taxes, to give you a sense of the sort of theoretical background that we use when preparing the report. Also talk a little bit about using the tax expenditure budget and some of the things to keep in mind when consuming the information contained in the budget. And I'll also talk about the difference between the way information is presented in tax expenditure budget and the way we present information when we do revenue estimates for the tax committees, which, if you don't serve on the tax committee, is the equivalent of a fiscal note for a provision that changes tax liability. And then I'll wrap up my brief remarks with some comments about what's coming up and what's going to be new in the next report. So for the purposes of the study, we consider that tax expenditures are statutory provisions which reduce the amount of revenue that otherwise would be generated by granting special and selective tax relief to a subset of taxpayers. That is, it's a tax law provision that changes the liability for only a subset of taxpayers. But another way to think about it, rather than reducing the amount of revenue, is that it requires a higher statutory rate than it otherwise would if we didn't have the tax expenditures. So you can think about it as either foregoing more revenue or foregoing a lower overall tax rate. If the only goal of the tax system were to raise revenue, then most economists and sort of fiscal academics would say that it's best to have a broad income tax base and low rates to reduce the decision-making distortions that taxes can make. But the reality is that our tax system, our policymakers ask the tax system to try and achieve a lot of public goals through the tax system. You know, we want to encourage home ownership, so we have the mortgage interest deduction on the income tax. We want to help pay for childcare, so there's a childcare credit. We want to recognize or reward the sacrifices of combat veterans, so we have the combat credit, and so on down the list. And importantly, any of these ends, we could design a direct expenditure program to try and meet the same goals. So it's a policy choice to try to incentivize this behavior or reward a certain subset of people through a tax incentive. So what do we, which provisions of the tax code do we consider a tax expenditure, and do we analyze for the purposes of the tax expenditure budget? So we have 7 criteria that are laid out in the introduction to the most recent study. And I should mention that the study is available on the Department of Revenue's website. If you go to the main page, look under policy and research, there's a section called major studies, and the tax expenditure budget can be found there. So for the purposes of our report, tax provision is a tax expenditure if all of the 7 criteria apply. The tax applies statewide, so we don't look at taxes that are only local in nature. The provision provides a preferential treatment. It has a revenue impact. So there are some provisions in the tax code that are obsolete that have no impact on taxes, or they may not be obsolete, but no taxpayers meet the criteria for it. And those we do not report in the budget. It's not subject to an alternative tax. So there are some provisions where there's an exemption from one tax, but that activity is taxed through a specialized tax. And we don't consider the exemption from the first tax then to be a tax expenditure if the legislature and governor have decided that there's a different way they'd rather tax an item. And examples of that are there's sales tax exemptions for motor vehicles, cigarettes, solid waste, and lottery tickets, but all those things have their own special taxes that apply to them. It's a
Ms.
tax.
Collette?
Yes.
Sorry, I just see that Vice Chair Senator Rest has a question. She has her hand up.
Thank you, Chair Gomez. Does these alternative tax, your number 4, does that includes the minimum tax for corporations? Is that correct, as well as the AMTs, or is it a broader alternative than is in the franchise tax or the individual income tax?
Thank you, Senator Rest, Madam Chair. So the alternative minimum tax is considered to be part of the basic structure of the like the tax rates and the filing status for the income tax and for the corporate tax. So we do not consider alternative minimum taxes to be a tax expenditure. We certainly, when asked, provide information on the impact of the alternative minimum tax, but we don't put it in the tax expenditure budget.
Thanks.
Something has to not be counted as a direct expenditure to be in our report. So another way to say that is if it's in the regular budget setting process of the legislature, if it's a direct expenditure that shows up on the books, so to speak, for MMB, then we don't count that as a tax expenditure. Like the local aids and credits and property tax refunds are a separate line item in the state budget. So we don't feel the need to also include them in the tax expenditure budget, even though they're tax related. To be a tax expenditure, the legislature has to have the authority to impose the tax. There are some things we exclude from the tax expenditure budget because the legislature and governor don't by themselves have the authority to change them. Some things, some examples of that include income tax exemption for federal bond interest. Because it's a federal law, states are prohibited from taxing that. So you don't have the authority to eliminate that tax expenditure. Some property tax exemptions are set by the Minnesota Constitution, so that it would require a constitutional change to eliminate those exemptions. So those do not show up in the tax expenditure budget. Finally, something has to be included in the definition. If something is included in the definition of tax base, as I said, it's not considered a tax expenditure. And I'll talk about the reference tax bases now. So since tax expenditures are considered an exception to the general rule, we have to establish what the general rule is for each of the taxes. And that's what we call the reference tax base. And those are defined in the introduction to each of the chapters in the report. I'll only talk about the 3 or 4 biggest taxes this morning, but if you're interested in any of the other taxes, there is information in the report on how we choose to define the reference tax base. So it's important that we're not implying that the reference tax base as we define it is the ideal tax base. That is the legislature and the governor's job to determine that, but it is through it is what we consider to be a reasonable definition of what a standard tax base would be. So we can say what we want to measure as a tax expenditure being a deviation from that standard. And for income taxes, which is our largest tax, we use what's considered pretty much a textbook economic definition of income, which is income from all sources, less expenses that are reasonable and necessary to generate that income. So deductions that are allowed so for true depreciation, because you need to purchase goods that you use to generate income, and the value of those purchases decline over time. So standard depreciation is considered to be part of the reference tax base. But in our tax code, we have deviations from standard deviation to give accelerated depreciation and upfront expensing and things like that. Those differences between standard depreciation and what's in our tax code are considered a tax expenditure. So the extra acceleration of depreciation is a tax expenditure. We consider the standard deduction and the rate structure to be part of the basic tax structure, as well as the ATM. Graduated rates and brackets, those aren't considered reference tax base. So if you make changes to those, that doesn't really change anything in the tax expenditure budget, but it obviously has a significant impact on taxpayers. And for corporate tax, equal weighted apportionment is considered to be the standard for the reference tax base. The fact that we have 100% sales apportionment rather than an equal weight of sales, property, and payroll, the difference between equal weights and our 100% sales is considered to be a tax expenditure because it shifts the taxes for some taxpayers.
Mr. Willett, I just see that Representative Hertas had a question.
Yes.
Thank you, Madam Chair. Mr. Willett, just kind of as we moved on to the next slide, but I was thinking about the 7 criteria regarding the tax expenditure. Does the privilege, I guess, of putting something that meets all of this criteria by making it part of a line item on the governor's budget, that disqualifies it from being defining a tax expenditure? Did I understand that correctly?
Mr. Willett?
Madam Chair, Representative Hertas, yes, that's correct. I mean, one of the purposes, the main purpose of the tax expenditure budget is to fill in the gap where the regular budget process offers the legislature and the governor an opportunity to review everything that is contained in budget items in the regular budget process. So one of our considerations is, well, if it's already part of the regular budget process, you don't need to also have information about it in the tax expenditure budget. So we're trying to just fill the void, the information void of things that are missing from the regular biennial budget with the tax expenditure budget.
Representative Hertas, is that good? Or do you have
Thank you, Madam Chair. And I guess I was just a little troubled by that executive authority with regard to putting together budgets. You would think that if we're reviewing tax expenditures, we should, as a legislature, be aware of what the cost of some of these programs are. And I think eliminating some of those line item issues perhaps complicates the budget process. I just would think that in terms of balancing budgets, we need to know what the cost of some of these programs really are, and having it exempted from being included in a report or knowing how much we're spending to support a certain program seems to be politically motivated rather than just looking at this objectively.
Madam Chair, Representative Hertas, let me try and answer your question again. When we say in the definitions on this sheet that it's not included in so the idea is tax expenditures will be in the tax expenditure budget. Direct expenditures will be in the regular budget. So the idea is things are supposed to be in either one or the other, other than the things that don't meet some of these other criteria. But we do provide information for things like the rate structure and standard deduction and things like that. But all the like the property tax refunds and things like that, the aids to local governments, those are all in the regular budget. So the governor's budget pages will include a budget page for local government aid and a budget page for the property tax refund and taconite aids and that sort of thing. So I believe that the idea is that the information you need will be contained in either one document or the other. And as I said earlier, the purpose of moving the timing of the tax expenditure budget is to get those two documents aligned so you have them presented to you at roughly the same time.
Thank you, Mr. Willett. And I just want to say that, you know, in my opinion and my relatively limited experience here at the legislature, it's like these direct expenditures have undergo a lot more sort of scrutiny and analysis. And that's the whole reason that we're coming together to kind of open the dark box of tax expenditures, is because, you know, related to the direct expenditures that we deal with in our committees, where we are more kind of subject matter experts, you know, this has relatively little scrutiny. And so the intent certainly is not to, you know, if I think Representative Hertas, you and I are both concerned about the sort of legibility of this process to the public and, you know, just being transparent. And that's what the effort here is about, is to sort of move tax expenditures more in alignment with those direct expenditures. I don't believe it's any kind of politically motivated effort to hide anything from the public. But if you had another comment, please go ahead, Representative Hertas.
Well, yeah, thank you. And I think you're touching on a little bit of what I was concerned about, or that we share that concern. I think when you think about a committee as being a tax expenditure review commission, that you're reviewing all tax expenditures. And I think it's somewhat odd that you maybe don't have some of those line items that are in the budget not being reviewed. I think I understood from your answer that the fiscal notes are directly associated with those line item things, but it's kind of unfortunate if some of those budget items meet all of these criteria of being a tax expenditure, that they're somehow exempted from cursory review by this newly established commission. And I think that's the point I was trying to make.
Thank you, Representative Hertas. Mr. Willett?
Okay, just a little bit more in defining the reference tax base. So for the sales tax, the definition that we use is all final purchases of tangible goods or services. So business purchases of capital equipment are in the base for the reference tax base. It's not defined as a consumption tax, so it's about final purchases of tangible goods and services. So it includes information about many services that including business services, which from a economic standpoint may not be a good idea to tax. But in the past, when we've presented this information, the legislature has appreciated getting the extra information about the size of exemptions for business inputs and business services. So this is a case where we're augmenting the information that we're providing, but it's clearly a case where, you know, economists would say, well, it's not necessarily a good idea to get closer to the reference tax base, because most people would say you shouldn't tax business inputs because you get a pyramiding effect where the good is taxed when the business purchases it and when the business sells their final product. And for the property tax, the reference tax base is the market value of real property. So if you were to strip away the classification system and some of the other credits and stuff, you would get to distributing taxes based on market value alone, which is a very different base than what we have after the tax expenditures are added. One of the differences in consuming this report, the property tax chapter is quite different from the others because local governments set a levy rather than a tax rate. We consider the effect of tax expenditures to shift taxes among property rather than to increase or reduce the ultimate amount of taxes raised. So conceptually, the property tax chapter is a little bit different. Those of you who serve on the tax committee or the property tax division are familiar with the policy issues around grappling with the shifting that can happen when you change property tax policy, and you end up providing tax relief to one class of property while shifting taxes onto other classes of property. This slide just shows the distribution of the tax expenditures by tax. The bulk of them are in the individual income tax and the general sales and use tax. About 2/3 of the total expenditures come from those two chapters alone. And most of the other tax types have a relatively few tax expenditures. This next slide is just an example. If you were to open up the report of what is contained in the tax expenditure budget for each one. So each one has a unique number. The first number is in relation to the chapter. Chapter 1 is the individual income tax. Number 66 in chapter 1 is the home mortgage interest deduction. So you have a title. This is on page 63 of the most recent tax expenditure budget. You have the statutory citation for the tax expenditure, a description of what current law is, how it works, a history of this particular tax expenditure, an estimate of the number of taxpayers or returns that are affected by this tax expenditure, and then an estimate of the dollar impact of it, what would happen if you eliminated this tax expenditure. So if you eliminate the home mortgage interest deduction in isolation, our estimate is that in fiscal year 2023, it would have about an $83 million impact on the revenues from the individual income tax and would affect about 138,000 returns. So that's just an example of the 300 tax expenditures in the budget. So the tax expenditure budget can give guidance on the impact of past policy choices. So all of these tax expenditures were choices by a legislature at some point in the history of the state. Three cautions that I'd like to talk briefly about when using the tax expenditure budget. So repealing some of the tax expenditures would increase complexity. Repealing some of them would cause compliance problems, and some of the tax expenditures interact with each other. So you can't necessarily just simply add numbers together in the report.
Mr. Willett, sorry,
yes.
Senator Rest just had a quick question, I believe.
Thank you, Madam Chair and Mr. Willett. The increase that's shown between 22 and 23 on the home mortgage interest, what is the assumption that's made about that increase? What is it based on? And if you did it now, would for the coming years, would we see an 8-9% increase in inflation that we're looking at now reflected in those numbers? Or how did you get to 78 to 83, et cetera?
Madam Chair and Senator Rest, so the answer to that's going to be different from one tax type to another. For the individual income tax, this is using this information comes out of the microsimulation model, the HITS model that's used by us, Dr. Kolomakidis's team, and the House and Senate research staff.
Okay.
So it's based on a sample of income tax returns from the most recent year that we have full data for. And then we use the assumptions from Dr. Kolomakidis's forecast for growing through the forecast window. So her team comes up with the growth rates in the income tax and the corporate tax and the sales tax, and we use those to grow the tax expenditures over time. Some of them grow at different rates based on special information that we have. For example, the Social Security income, part of that income is a subtraction in Minnesota law because the number of Social Security recipients is growing faster than the general population. That tax expenditure, at least in the short term, is going to be growing faster than a lot of other individual income tax items. So where we have more specific information, we'll bring that to bear when doing the analysis. But generally speaking, we follow the forecast assumptions when preparing these reports.
Thank you, Mr. Willett. Anything else, Senator Rust? Are you good? Okay.
Okay, in the interest of time, I'll just briefly touch on these, but I'm happy to talk about them anymore. Some of the tax expenditures would significantly increase complexity if you repealed them. And that's the sort of information that you'll want to consider when you start doing your evaluations and analysis of tax expenditures. Many income tax and corporate tax provisions piggyback on federal taxes. That's what we call federal conformity in the tax committees. Decoupling from federal law can really increase complexity for both the taxpayer and the department. As you all have heard from your taxpayers, because we have been out of compliance with some of the new federal provisions for the last couple of years, decoupling, especially from timing provisions, can really increase the complexity for accounting for businesses. They may have to keep two sets of books, one for their federal taxes and another for calculating their state taxes. So those are the sorts of tax expenditures where it may be a really good idea to have those expenditures for administrative ease for taxpayers. So accelerated depreciation and deferred comp, those sorts of things would be examples of that. A repeal of some tax expenditures would create compliance problems. If you think about, there are tax expenditures where it may be hard for taxpayers to comply if we were to repeal them because they don't really have the information necessary to calculate that impact. Many employee fringe benefits and Medicare benefits, for example, right now there really isn't the type of robust reporting that's necessary to make taxpayers know what numbers to put on their tax returns. So some of those sorts of things, again, are considerations you would want to take into account. Maybe for the ease of compliance, it's a good idea to maintain those tax expenditures. And finally, there are some interactions among tax expenditures. This is probably most pronounced with itemized deductions on the individual income tax. Repealing any one itemized deduction is what's measured in the tax expenditure budget. But if you were going to repeal more than one, the combined interaction would be less than the individual amounts, because as taxpayers switch from itemizing to taking the standard deduction, if you were to repeal an additional standard deduction, that wouldn't impact them anymore because they're already taking the standard deduction. So there's sort of a diminishing return the more itemized deductions that you repeal. And this just shows that if you simply were to add up items 1.63 to 1.68, which are the itemized deductions, they would add up to $250 million. But if you adjust for interactions, the net impact of repealing all those we would measure is only 170 million. This is by far the biggest example of interactions. There are some other minor interactions, but this is kind of the really big one to keep in mind. And I just, one of the things that staff asked me to touch on is the difference between tax expenditure estimates in the report and how those differ from the information we provide when we create a revenue estimate. So revenue estimates will take into account these interactions. So if you had a proposal to repeal 3 of the itemized deductions, we would take those interactions into account when we do a revenue estimate, whereas in the report, they're just each individually listed. One The budget also ignores any secondary impact on other taxes. So a change to motor vehicle registration taxes, because those are something you can deduct on your income taxes, there's an interaction between the motor vehicle tab fees and the income tax liability. In a revenue estimate, we will mention that interaction, but you don't see that in the tax expenditure budget that just looks at each policy in isolation. The revenue estimates also have a specific effective date because legislation has a specific effective date, whereas the tax expenditure budget just shows the impact over the full budget window. Whereas you have to take into account revenue estimates. You have to take into account the effective date for revenue estimates, because that timing is really important in terms of what the revenue change would be within the forecast window. And we only do this report every 2 years, whereas there's two economic forecasts every year. So revenue estimates can be updated for the most recent economic information. And so they'll have fresher information than the tax expenditure budget does. So as I mentioned, the next report is due in November of 2024. And that will enable the consideration of tax expenditures and direct expenditures at the same time, which is one of the purposes of the law change that created the Tax Expenditure Review Commission. We'll be providing some new content in the next report that was required from the same legislation. As you identify purpose statements for the tax expenditures, we'll be putting those into the report as well. So they'll be contained within the tax expenditure budget. We'll also be estimating what the potential rate change reduction could be if a provision is repealed. Right now, we just show the dollar reduction in taxes, but we'll show both that or the opportunity to reduce a tax rate, which for a lot of the tax expenditure will be a very small amount, but I think it'll be very useful alternative information because it's a good way to think of the opportunity costs that tax expenditures create. And we'll also be adding incidence analyses of significant income and sales tax expenditures. Significant is defined in the legislation that was passed, so we'll be following that definition. And it means sales and income tax expenditures exceeding $10 million per biennium, but not including federal conformity items or business tax credits and provisions that are designed to avoid tax pyramiding. And significant isn't meant to connote that they're more important. It was just a definition that the authors came up with to identify for which tax expenditures would incidence analyses really be most useful and provide the most useful information. And just as a reminder, an incidence analysis means we will show what the estimated impact of that provision is by the income range of the taxpayers. So for example, the one we talked about earlier, the mortgage interest deduction, we would show what the distribution of the tax increases would be from a repeal of that tax expenditure by income range. So it just gives an additional piece of information for you all to consider when you're doing your evaluations. And with that, Madam Chair, I will be happy to take any more questions.
All right. Does anybody have any further questions for Mr. Willett? Just allow a moment. Not seeing any. Thank you so much for this information. I'm especially excited to hear about the modifications that we can expect or the additions based on the statute that was passed that we're going to see in the upcoming tax expenditure budget, especially that incidence analysis, I think will be really helpful as we're moving through our work. I also want to just lift up what you mentioned sort of in your last few slides. The statute talks a lot about kind of analyzing the efficiency and the effectiveness of our tax expenditures. And I appreciate you just helping us to remember, the ways that these interact with each other, the kind of administrative burden of potentially introducing further complexity to what is already kind of a complex system that we've put together. So those are some of the things that I'm going to be keeping with me. And so I want to thank you again for all your work and for going through it with us today. I think this is going to help us just sort of to get grounded in where we're going. So thank you
Thank
very
you,
much.
Madam Chair and members.
Absolutely. All right, so next we're going to welcome Dr. Laura Kalimbakidis, the Minnesota State Economist, to the Commission. Doctor, if you could please state your name for the record and then go ahead with your presentation.
Sure.
And I'm kind of liking people being able to sort of raise their hand during, I feel like it's a little more conversational. Is that good with you if we continue doing it like that instead of?
Yeah, Madam Chair, that's fine, especially if you call out the questions, because I may not be looking at that screen at the moment to catch the hands. So thank you.
Absolutely. I'll keep my eye out for that. So thank you.
Great. So for the record, I'm Laura Kalimbakidis, Minnesota State Economist, and I'm a professor of applied economics at the University of Minnesota. I'm going to share my screen. And so so thank you very much for having me here today. I'm very pleased to be here to talk to you about the tax expenditure review report from 2011. And I'm just very pleased and excited about the work that the Commission and the LBO and the Department of Revenue are undertaking now. It's a topic that obviously I've been interested in for a long time, and I'm really pleased to see the work that you guys are getting started on. So what I was asked to talk about today is talk a little bit about the 2011 report, some notes on defining the reference tax base, although Mr. Willett did a great job explaining how that's done for the tax expenditure budget. What are the components of a quality review of a tax expenditure, and then how would one develop a review schedule? So just to be clear, I'm not going to answer all of these questions for you. I'm just going to share some of my thoughts. So the first thing is to talk about the report itself. It was produced in 2011. A lot of the work was done in 2010, I think, by the Department of Revenue with assistance from a group of economic and public policy professors. Marcia Blumenthal, myself, Jay Kudrowski, John Spry, Judy Temple, and Jenny Bourne, all of whom are or were academics with expertise in tax policy and public finance. It was having our report done was a statutory requirement. So I think it might be helpful to think about the problem that this group was addressing. So what we thought we were trying to do, and why economists, tax policy economists, are particularly interested in the topic of tax expenditures. So Mr. Willett started out talking about this. I'm going to talk a little bit more about allocative efficiency, and it's not just in this slide, but in another slide, I've got some points on this too. But the basic idea, and I'll explain in a minute where this comes from, is that a broad tax base with low rates improves allocative efficiency, and that means that it limits the tax system's interference in economic decisions. So throughout my slides, I've referenced, the page references are to that 2011 report. Now that's a key primary goal of tax policy from an economic standpoint, but the report acknowledges throughout, and I'll acknowledge myself, of course, that efficiency is not the only goal of tax policy. There are other key goals, including simplicity. So can you administer is it simple enough to administer and to comply with? Fairness, equity, is it treating people fairly? And then Mr. Willett outlined a number of other policy goals that specific tax expenditures are trying to address. So there are lots of other goals of tax policy. But let me focus on this efficiency for a while. So because allocative efficiency is a key goal of tax policy, and tax expenditures move you away from the broad-based low rate objective, they deserve some scrutiny. Their bar should be pretty high for taking things out of the tax base. So let's examine them. As I think it was Senator Rest already brought up, tax expenditures receive less scrutiny than direct expenditures, especially through the budget process. And so there's no automatic review, automatic authorization, or at least there wasn't prior to this this report being written. And so let's bring that scrutiny to bear here. The report also writes about how there may be an institutional bias toward using tax expenditures over direct expenditures. And the idea here is that if you want to, so Mr. Willett pointed out that some of the tax expenditures he listed could be replaced from a policy standpoint with a direct expenditure. Why are they in the tax code and not as a direct expenditure? Well, one of the reasons may be that when you enact a tax expenditure, you're lowering somebody's taxes. And so that makes it look like you are shrinking the size of government. Whereas if you enact a direct expenditure to subsidize something, you're increasing the budget and increasing the size of government. That's an illusion, which the tax expenditure budget, as Mr. Willett explained, is designed to get rid of that illusion, to show that every kind of expenditure should be either in the tax expenditure budget or the direct expenditure budget. But that illusion creates an institutional bias toward doing these things as tax cuts, tax reductions, rather than as direct expenditures. And the report writes a lot about needing a process to ensure that tax expenditures constitute sound public policy and meet the objective for which they were created. So the report is encouraging, recommending that exactly what you're about to do is something that needs to be done, that these tax expenditures had a goal, there's some policy reason for having them. Let's evaluate them and see if they're actually doing what they say. So the goals were to give the governor, legislators, and other public officials, including the general public, access to all relevant information on tax expenditures and to provide new information as needed. And then also, this is what the report recommended, bringing these tax expenditures into the budgetary process to require approval or non-renewal of these provisions by the governor and legislature. So transparency, it's about transparency. It's not about, the goal wasn't to eliminate tax expenditures, because we acknowledge that while efficiency is a key goal, there are other goals of tax policy too. But to review the tax expenditures. So this reviewal may result in modifying them to make them more effective, repealing them if they're not doing what we think they're supposed to do, or we just don't think that's the purpose is important anymore, or worth the money anymore. Or it could result in affirmation of these tax expenditures, that we've evaluated it, we've shown a light on it, we've scrutinized it, and we think this is exactly what Minnesota's tax policy should look like. So to review our report, the 2011 report, the report does a lot. These are the main things. It discusses the reference tax base for each major tax. Mr. Willett has already done a great job of that. So I'm not going to go into details, although I will talk about it a little bit in the next slide. It then explains the tax policy principles. As I said, there are a variety of goals or principles of tax policy and other policy objectives against which to evaluate tax expenditures. And in that section of the report, it also discusses the resources needed to do that work, that some of what is being asked for in our 2011 report could require a substantial amount of work. And so there's a discussion of those resources. The report also identifies the criteria for prioritizing evaluations. There are a lot of tax expenditures. Do we just walk through them alphabetically? How do you prioritize your efforts here? And then it describes a process for integrating tax expenditures into the budget process. The 2011 report is also available online. I think it's in the same place where the tax expenditure budgets are, in the Minnesota Department of Revenue website. And the full list of recommendations from the 2011 group is included in an appendix in the report. I didn't say anything about the process of producing the report. We met, so the director of the tax research at the time, Dr. Paul Wilson, led the group, and then we had Mr. Willett was also a part of this process as the expert on property taxes at the time. And the group of professors that I talked about, we all met many, many times over the course of this year and a half or whatever it was. A lot of the work was done in person, in conversation, and then going back to write sections of the report and do some analyses and make decisions, and then come back and bring it all together. But it was a lot of in-person meetings with some, I think, really open discussions about tax policy. So let me talk a little bit more, I guess, some staff questions about the idea of efficiency and what it means in this context. So efficiency, of course, that word has many meanings, so I want to clarify what it means in the context of the report. It's one of the key goals of tax policy, and here's where it comes from. So allocating economic resources toward their most productive use is perhaps the chief advantage of free markets. Now, this is a quote from the report. So that means, so this allocative efficiency, directing resources toward their most productive use, is in effect a way of making the economic pie as large as possible. So allocative efficiency means that you are directing resources in a way that overall or aggregate well-being is maximized in the economy. And a mark of effective tax policy is the preservation of incentives for individuals and businesses to make decisions on the basis of that use of resources, the productive use of resources, rather than for tax benefit. So maximizing well-being or maximizing the size of the pie doesn't, just as this is as an aside, but it's an important aside, doesn't say anything about the distribution of that well-being. So this is just about economic growth and maximizing economic growth. It's not saying anything about who benefits from that. So there's going to be a distribution of outcomes. It has some people at the top and some people at the bottom. That's not what this is. Redistributing that is not what this principle is about. But it means that it assumes that households and businesses are the best arbiters, the best decision makers of what's best for themselves. And when they're free to make choices, so choices like how much to work, where to live, what to buy, how much to produce, whom to hire, all of those decisions, when individual households and businesses are making those decisions free of consideration of tax policy, overall well-being is maximized. So the next quote is from Tax Policy Center .org, the Urban Brookings Tax Policy Center, and they write, in the longer run, a tax system with low rates and a broad base is more likely to promote prosperity than one with high rates and a narrow base. Now, then they go on to talk about lots of nuance to that, but that's the basic idea. So economists tend to define the reference tax base in the broadest way. So what tax base would generate revenue while interfering the least in people's decisions? So a broad tax base, where, to be clear, a broad tax base means you're taxing everything that's reasonable to tax within income. So Mr. Willett talked about the reference tax base for the income tax. All forms of income less the expenses necessary to generate that income. That's a broad base without a lot of, so every carve out from that becomes a tax expenditure. So a broad tax base interferes less in decision-making because, for a couple of reasons. One is that it can collect the same amount of revenue with lower rates on income, sales, profits, et cetera. And so lower rates are less a factor in choices about how much to work, what to buy, what to sell. So if you have not carved out a lot of things from your tax base, the overall rate can be lower, not just on that tax, but on other taxes too. And those lower rates mean that you haven't distorted the price signal as much. So people make decisions based on price signals. And when taxes are not part of that price signal, then that's an accurate signal. But when taxes are part of the signal, then it might nudge people away from what their optimal, their best choice was. And then the other way a broad base it removes that interference from decision making is that there's no way for the taxpayer to avoid the tax by making a different choice. right? So if you tax a particular make or model of car and not the others, so you've got a tax on cars, but you've carved out everything except one car, I guess is the way to think about that, then you are distorting decision-making because people are going to move away from the highly taxed vehicle toward the lower taxed vehicles. Whereas without the tax, they might have made it a different choice. If it's a broad base where you're taxing all cars the same, then you can't avoid the tax by making a different choice. So it's more efficient in the economic sense. Now, a tax expenditure, on the other hand, narrows the tax base and influences decision-making. Of course, as you heard from Mr. Willett, and as you all know, sometimes the very purpose of the tax expenditure is to influence choices, right? So you might put allow a tax credit for electric cars because you want people to buy more electric cars. So there is, again, a tension between allocative efficiency and other goals. And that's a balance that any evaluation of tax expenditures is going to have to make. All right, so my next section is components of a quality review. All of this material is in pages 17 to 19 of the report, and here's what our group was recommending, is that a quality review identifies the purpose of the tax provision. You're getting that now. You're getting that, according to Mr. Willett, you're getting that in the next tax expenditure budget. So you can see why this matters. Is because I was saying that the problem was we don't know if these things are doing what they're supposed to be doing. We don't know if they're achieving the policy objectives they were meant to achieve. Well, in order to evaluate them against those objectives, we first need to know what the objective is. So we need a purpose statement for the tax provision. And then we need to measure the tax provision's impact relative to that stated purpose. And the report identified several pieces of information here. First would be the number and characteristics of those who pay less tax as a result. So Mr. Willett said that that's going also part of the tax expenditure budget now, is that we have always, the tax expenditure budget, I think, has always included the number of taxpayers affected. Now it's going to include the incidence of the tax expenditure by income range. And so it's going to tell us who's affected by income, which is critically an important characteristic. I've got an asterisk on this because I was thinking about what characteristics we might want to know about. And I think that if we went back 11 years to the conversation among our group, they would say, well, we want to know about income, right? So we want to know if these tax expenditures are benefiting high income people or low income people. And we might have also said, well, it'd be great to know, I don't know if we can know, but it might be interesting to know if there are differences across location, across the state, regional differences. Maybe we would have come up with age as an interesting characteristic, but I doubt we would have come up with race, ethnicity, or gender, because tax policy, because on tax returns you don't get that information, tax policy has tended until fairly recently to not do a lot of research on how tax policy affects people by race, ethnicity, or gender. That it's a fairly nascent research area in tax policy that now economists are doing this work. There still isn't information on tax returns about these characteristics, and so they need to impute the characteristics from other sources. So that's what I mean. It's a fairly new area of research, but I'm putting that in there because not because I expect Mr. Willett's staff to be able to do it. I'm just telling you it's something we can't really do now. But if this group were to have this conversation this year, I think we would have had a conversation like this, and we would have brought up these characteristics as something to think about. Another aspect of the impact is the change in behavior as a result of the tax expenditure. So many tax expenditures are trying to induce changes in behavior. They're trying to get you to buy more solar panels or an electric car, or trying to support childcare costs, reduce childcare costs so that you can work more. They're trying to get a behavior change, and that should be part of the analysis. And then unintended results. Some tax expenditures do something that we did not intend at all, but we should analyze that and see if those are there. The second big piece is measuring the net indirect impact of the provision within a balanced budget context. So the report focuses on indirect economic development impact, the idea that you could have a tax expenditure that changed behavior in a way that affected economic development. But I'm expanding it here to say, well, the society level or community level secondary impacts could be economic, social, or environmental conditions. So you might have a tax credit for solar panels, the goal of which is not just to get people to buy more solar panels, but actually to have an impact on climate change. I know these sound like lofty secondary impacts. That's part of the challenge of evaluating tax policy. So identifying the purpose will help figure out how deep you might go in the measuring these impacts. So if the goal is to, thinking back to one of Mr. Willette's examples, to support combat veterans, if the goal is to provide a benefit to combat veterans, period, then maybe that's the end of your analysis is, are we supporting combat veterans? Yes or no? If the goal is to encourage people to enter the military, then you've got another set of analyses to do to figure out if you're actually doing that. Let me see, there was something else I was going to say about that. It's on the next slide. So I'll talk more about these direct and indirect impacts coming up. Another part of the review that, again, sounds like it's going to be in the tax expenditure budget now, is calculating the revenue neutral rate reduction that would be possible with repeal of the provisions, not just the cost of the provision, but how much could you bring rates down if you repealed it? And then considering alternatives to the tax revision that might have a similar impact. So those might be, I think the group was probably thinking about what are the direct expenditures that might have the same impact. Move on to the next slide. So this measuring direct and indirect impacts, this is the meat of that last slide. So the components of the quality review, the big, it's obviously the big tough part of it, because these are the parts that haven't already been incorporated into the tax expenditure budget. So what we're talking about here is we're talking about program evaluation. We're talking about policy analysis, which is done in the tax policy realm, but is also done in the direct expenditure realm. It's evidence-based policymaking is what we're talking about here. And it may require considerable effort, cost, and time. Some may not require that much cost and time, and there may be ways to get some quality review without considerable effort, but some of these really are going to require some research. So the first part, in the direct impacts, those behavioral impacts, will require some behavioral science and economic research on the impact of tax provisions on household and business choices. There is a lot of research that is being done on these things. And so if you look at my box at the bottom, examining the results of peer-reviewed research on similar provisions in other jurisdictions can provide a lot of information. It's great if we can do some of this behavioral analysis on Minnesota, but that might not be feasible, nor might it might not be necessary, because you may be analyzing a provision that exists in other states, in many other states, and research has already been done on that. For instance, lots of states have sales only apportionment in their corporate profits tax or their corporate franchise tax, and there is a lot of research on it. And so you may, through a good literature review, be able to get plenty of information there. But if you were going to do original research on this, you would be doing some multivariate regression analysis, comparing tax data across time or across jurisdictions. And the multivariate regression analysis means that you're putting in enough variables to control for other factors so that you can identify what the impact of the tax provision itself was on behavioral changes. You might also do microsimulation using tax return data. You learned a little bit about that from Mr. Willett. You might need to do that if you were doing something on income tax and spending, you would need to supplement the tax data with imputations of other relevant data, for instance, on consumer purchases, or maybe saving. Your part of the purpose was try to induce saving. So you would need some information on that. None of this is trivial. This is important and interesting work. A lot of tax policy research these days is done with field experiments using random control trials, which then also do have controls in them so that you can identify the impact of the tax provision on behavior change. And I will emphasize again that it's great if we can do some of these things, generate original research here in Minnesota. A first step, if I were doing this, my first step would be to get a very high quality literature review on the provision that I'm analyzing to see what other people have learned about it. And then the secondary impacts has to do with, so generally, I think I suggested this before, but generally the behavior change is not the only thing, not the last thing we're interested in. It might be that we have a tax credit on solar panels because we want to support demand for solar panels to support the solar panel industry. That's possible, but it's also likely that the reason we have that credit is in order to generate an environmental change. So then the secondary impact is research on the impact of those behavioral changes on economic, social, or environmental conditions in a balanced budget context. I didn't mention this in the last slide, but again, in the report, the focus on these secondary impacts is on economic development impacts. And it's very important that if you're looking at economic development impacts, that you look at it in a balanced budget context, that if you have lowered taxes on one industry, for instance, in order to try to induce investment in that industry, it's not fair to look at the economic development impact of that in outside of the context of the fact that you would have had to raise taxes on someone else in order to balance that budget, or you would have had to reduce spending somewhere else in order to balance the budget. So just lowering taxes might have a stimulative effect, but because we have to balance the budget, you have to consider the effects of what did you do to balance the budget there. So that's what I mean by the balanced budget context, and the report is clear on that. The report also points out that for these economic development impacts, it's a real challenge to try to figure out what those secondary impacts are. And some of those indirect impacts, some of the analyses of those are of poor quality. Some of them are high quality, some of them are poor quality. And so, it can be a fraught area to jump into. I should have put this on my slide, but I didn't notice it until later. And so I just put it in my notes. That here's a quote from the report about this. It is unrealistic to expect that the tax expenditure evaluation process will be able to pinpoint the secondary impacts of alternative tax expenditures on the state's economic performance. So it's not realistic to even expect current economic models to be able to say this tax expenditure improved Minnesota's economy this much. So, exercise, I'm recommending caution in thinking and sort of a lack of ambition about estimating these secondary or societal level impacts. All right, developing a review schedule. This is toward the end of the report. These are the criteria that the group came up with for figuring out which should be identified or evaluated first. Is it indeed a tax expenditure? Okay, so you can kind of ignore the first one. Could this tax expenditure be easily replaced with a direct expenditure? And Mr. Willett talked about the difference there. Is it costly, or is its cost growing quickly? So is this something that's running away from us in terms of cost? has it drawn legislative interest for modification or repeal? Is it something that a lot of legislators are thinking this is something we really need to examine? Is it difficult to administer? Is it just is it burdensome to administer or comply with, I would say? And would repeal not pose significant problems? So Mr. Willett talked about this, about some of the federal conformity provisions and some of the tax expenditures that would make matters worse if you got rid of them in terms of compliance costs. And the report notes in particular federal conformity provisions with timing and information issues. And the report outright says those should be a low priority for evaluation because of the complexity, the additional complexity it would cause to get rid of them. The report makes clear that this is not a hit list. That's a quote from the report. Evaluation may lead to improved public policy through modifying or repealing a tax expenditure, or, as I said before, by transparently affirming that the provision is doing what it's supposed to do. So just because one is up for evaluation doesn't mean it's a foregone conclusion we're going to try to get rid of it. It could be we're going to evaluate it and find out this is a brilliant use of state funds. This is exactly what we want to do. So what do we do with, this is my last slide. So what do we do with this list of criteria? Well, in the report, our group went round and round, back and forth with lots of input from one another and from other places, and created a list. Here are the priorities for each tax. But that was 11 years ago, and things have changed a lot. Tax Cuts and Jobs Act changed behavior regarding itemized deductions. There have been all sorts of law changes. So I'm not sure you can just grab the list that we came up with. But it's certainly something to look at, to read and look at. I think there's two ways of thinking about this. One would be, do you go after the big kahuna? Like, do you take the largest ones, the most expensive ones, the ones that are growing, and that's where you focus effort? Because you can get a lot of, the cost benefit is going to be good for spending a lot of effort on the expensive ones. Or do you go for the low hanging fruit? So I'm thinking, and that gets some wins, some quick wins in terms of, well, we evaluated this one and we're going to propose modifying it this way, or we're going to make a recommendation about it. What I think are low-hanging fruit would be, so ignore the first criterion, which they're all going to be part of, but low-hanging fruit would be, could easily be replaced by a direct expenditure. Like, there's no great reason for it to be in the tax system, and it could be direct. It's difficult to administer, right? So those actually kind of go together, that sometimes a tax expenditure is more difficult to administer than a direct expenditure for the same effect. And the repeal would not pose significant problems. So I think those are the low-hanging fruit. And I think it may be of value to tackle some of those kinds of things early to get your process in place, and as I said, have some early policy wins. That ends my my presentation, so I will stop sharing, and I'm happy to take questions.
Great, thank you so much. Does anybody have questions? Senator Rest, please go ahead.
Thank you. So how would completely doing away with taxation that we currently have on Social Security income, how would that count? Would that be a direct expenditure, or does that come into the tax expenditure budget? And if so, at what point? And how about it if we applied it to all pension income that is, or pension income that is not, that's received by folks who don't pay into nor get any benefit from Social Security taxes? Thank you.
Dr. Kolumbakidis, I don't know if you want to take that, or if you want us to ask one of our nonpartisan researchers to kind of weigh in, but go ahead if.
Or Mr. Willett would
or
be
Mr.
fine too.
Willett,
Yeah.
Yeah, I would, if I were to start answering it, I would say, I would defer to Mr. Willett. So why don't you take it over, Eric?
Great. Mr.
Madam
Willett.
Chair and Senator Rest, those sorts of new exemptions from or reductions in income tax would show up in the tax expenditure budget. There already is a tax expenditure item for the small portion of Social Security that state tax creates as a subtraction. And if we expanded that, that tax expenditure would just get much,
Would
much
go
larger.
right there. Thank you.
And if we added other pension programs, those would show up as new items as well.
All right, Representative Schultz.
Thank you, Chair Gomez. Yeah, this is a question for Professor Kolumbakidis, I believe. So there are proposals out there to have a permanent tax cut because we've had a surplus. And there's proposals out there to give a one-time rebate of potentially up to $2,000 to every Minnesotan. I'm wondering, given our economic situation now with potentially higher interest rates in the future, which could affect the mortgage interest rate deduction, and inflation, other economic potential challenges in the future, what is your expert input on how the tax expenditures may change when people file their one-time income tax return? Should we have more money available because our expenditures may increase, for instance?
Dr. Kolumbakidis.
Madam Chair, Representative Schultz. I think that one of the goals, Mr. Willett talked about this, one of the goals of the tax expenditure budget and this evaluation process is to get in the habit of looking at tax expenditures and direct expenditures as part of the same thing. They should get the same amount of scrutiny. The bar should be the same height for increasing tax expenditures as increasing direct expenditures. So whether you, okay, so you're asking, given the budget situation, the state's budget situation and changing economic conditions, how much of the surplus should be spent on one-time expenditures versus ongoing, whether those expenditures are direct or tax expenditures? Is that?
Yeah, so I mean, I'm just, looking out into the future and
Yeah.
thinking that the feds are going to maybe increasing interest rates. People might have higher mortgage interest rates, which would lead to, for those who are entering into those new contracts or buying new houses with higher interest rates, how is that going to impact our state expenditures on some of those deductions?
So in terms of the cost of the home mortgage interest deduction, which Mr. Willett, gave as an example, and he talked about how his staff estimates that. In the next forecast, we would be providing them with a new economic forecast, which would include new information on interest rates and new information on home prices, I think. I can't remember if you get that or not, but the new economic conditions, the new forecast that we'll do in November will influence the next calculations in the tax expenditure budget. And so that will provide that information that you need in terms of how the cost of the home mortgage interest deduction and any other tax expenditures will change. And then let me pass it to Mr. Willett in case I've said something wrong.
Mr. Willett.
Madam Chair and members, no, that's correct. I think the other thing to remember though is even significant short-term changes in economics take a long time to affect the entirety of taxpayers. So most taxpayers' mortgage interest deduction isn't going to change course when interest rates go up. It's only the new ones that are added, or people who will no longer, have an opportunity to refinance or something like that. So it's a marginal impact. It'll be a larger marginal impact when there's a shock to the system, like a very large. And our projections are based on, the tax returns that have already been filed and then adjusted for the forecast. So it flows through in that way.
And Madam Chair, if you don't mind me interjecting that a more direct effect of interest rate changes and changes in the housing market is in the deed and mortgage tax revenues from the deed and mortgage tax, which my staff forecasts and will forecast in the fall. So you can look to see how that changes. It's not a tax expenditure, it's a revenue source.
Thank you.
And I have one more question, Chair Gomez. And so as we see, inflation, and I predict that it will level off substantially in the fall, we already see a drop in the price of oil, and gas prices are coming down significantly. And the inflation estimates just came out from yesterday. And I'm wondering if you have an idea of what assumptions you're going to use for inflation for our next forecast.
Dr. Kolombakidis?
Madam Chair, Representative Schultz, I won't know what the assumptions are for the November forecast until the beginning of November. So we don't forecast the macroeconomic variables that we use. We purchase a forecast from a consulting firm. Many of you know that. The reason being we don't have any particular comparative advantage in forecasting the US economy. And then we forecast Minnesota's economy off of that. So we get a new forecast from the consulting firm every month around the 7th or 8th of the month. And so in early November, we will know what they are forecasting for inflation. Of course, since our February forecast, their projections for inflation have gone up, because in February, we were working with a forecast that was prepared in the beginning of February, and a lot of things hadn't happened yet, including the Russian invasion of Ukraine and spikes in oil prices. So I am not going to guess what they're going to say at the beginning of November, because a lot can happen. But you're right that the most recent inflation number that I think came out yesterday doesn't incorporate the decline in energy prices that occurred through the month of June. And so things are going to look a little different come the next numbers.
And one more follow-up, Chair Gomez.
Go ahead.
Can you send me an email when you have those inflation numbers in early November? I'd be interested in learning about that in terms of the November forecast. Thank you.
Yep.
Thank you. Senator Weber.
Thank you, Madam Chair. Professor Kolombakidis, historically, if we have a national recession, how long does it take before we feel the impact within the state in terms of our tax revenues, et cetera? And I understand a lot deals with the deepness of the recession and what have you. But do you have a timetable that we can reasonably expect?
Dr. Kolombakidis, thanks we appreciate your presence here. And we're obviously taking advantage of, being able to go a little bit beyond the scope of what you presented on, but so we really appreciate it. But please go ahead. Thanks, Senator.
That's fine, glad to do it. Madam Chair, Senator Weber, great question. So let me talk about revenues. All revenues, there is a lag between what's happening in the economy and what you see in our monthly revenue reports. That lag is greater for different types of taxes than others. So the one that is more closely tied to what's happening in real time in the economy is the sales tax. That's got a monthly lag. And so if the US enters a recession, Minnesota won't be immune to that. We're closely tied to the US economy. And we can also have a conversation about what kind of recession that might look like: short, long, deep, shallow, or maybe not. Maybe we'll have a soft landing. We won't have a recession. But if there's a US recession, One of the characteristics of recession is the unemployment rate goes up. So Minnesota has an extremely low unemployment rate right now. So there is room to move there. We are well positioned to move into a slower economic period because we have very high demand for labor in the state. But as the unemployment rate moves up, people's incomes start to get hit and they might spend less money. So you'll see sales tax receipts slowing down before other things have slowed down. The income tax, there are pieces of the income tax that are tied to the current economy, and one is income tax withholding. So as the unemployment rate goes up, if people lose their jobs or start to have trouble finding jobs, we're going to see softness in income tax withholding receipts. So that's the money that your employer withholds from your paycheck. And we don't report on that every month, but we do every quarter. And so if that's starting to soften, you'll see me write about it in our quarterly report. A big part of the tax receipts, though, are the final payments, the checks that people write on April 15th, and those lag by more than a year. So that's the thing that we try to be clear about when our revenue reports show excess receipts in the income tax or a shortfall in the income tax. We're going to be clear that this has to do with final payments on tax returns that has to do with economic activity last year. So it's going to be a bit of a fuzzy story as we move in the next 18 months, that some receipts may soften if the economy is slowing down and some may not because they're lagging.
Thank you. Senator Weber.
Thank you, Madam Chair. It's also possible, isn't it, if we are seeing record inflation going on, that initially the sales tax revenues will increase even as we are going into a recession. Isn't that entirely possible? Professor
Dr.
Kolumbakidis?
Yeah.
Madam Chair, Senator, that's one of the counterintuitive or unintuitive things about inflation is that it can, in the very near term, it can boost tax receipts. So if real consumer spending, meaning the actual numbers of things that people buy, numbers of cars, numbers of Peloton bikes, numbers of lawnmowers, if that doesn't change, if people don't change their real spending behavior and the prices of all those things go up, then our sales tax receipts go up. And then, however, that doesn't go forever because overall inflation can drag the economic growth down, primarily through actions by the Fed. So the Fed is trying to slow inflation, and they're doing that by trying to put the brakes on the real economy. Inflation can also slow the economy by spooking consumers. And so consumer confidence is lower and they spend less. So this initial impact is we're going to keep buying the same number of things and we're just going to go ahead and pay those higher prices. Sales tax receipts might go up, but eventually the real economy slows down. And if the prices don't come down commensurately, then sales tax receipts will soften. At what point does that happen? It's not clear because there are other things going on, but that's one of the reasons we focus. If you've seen some of my presentations around the forecast, we focus on real GDP and real consumer spending because we're trying to see if those things are slowing down, even as prices are fluctuating.
Thank you very much for that. We are coming to the end of our time together, so I really appreciate this conversation, and I think that it reflects, just the realities that are in our communities as we're out talking to people, that this is really high on their minds. So I do appreciate your willingness to engage a little bit on these issues, Doctor. Thank you. So just want to thank again, Dr. Kolumbakidis and Eric Willett. Oh, I'm going to go to Representative Marquardt actually before we close out.
Well, thank you very much, Madam Chair. And first of all, thank you to the presenters. This is some really excellent information. What I wanted to say is that at the last meeting, there were a couple things that had been brought up that were maybe needed clarification in the law. And so one was where it said that in the first 3 years, the commission could review all of these tax expenditures. And we wanted, so in the House and what would have been in the conference report, we would have changed that to say you had up to 3 years. So you could do tax expenditures kind of before the 3-year limit. It, just kind of clarified that. And then the second point, I think, was brought up by Senator Bach, where it said the report would be from the previous year. Well, we had changed that to the current year. So those did not get through, but I want the committee to know, the commission to know that we did have those, and they would have been also in the conference report. So it's not something that is urgent, but we were trying to clarify a little bit. So just wanted to update you on kind of those concerns that were brought up and what we did. But Madam Chair, big thank you to all the members here. So.
Excellent. Thank you so much for that. Yeah, we didn't finish our business in the regular session, so there were some items left on the table, so I appreciate that. So yes, again, a warm thank you. I think that this has been really helpful to me, even though I've heard about both of these, the tax expenditure budget and this study before. This kind of deeper dive has been really helpful. At our next meeting is going to be on August 11th. And we're going to do our sort of final piece of grounding for our work ahead in that meeting. We're going to hear from researchers from the tax incentive program at the Pew Charitable Trusts. And so one of the things as we were discussing how to most effectively do this work was just to look, as we often do in policy, at how other states have been doing this work. So we have, we're lucky enough to have some states out there who are a little ahead of us. And so the Pew Charitable Trust folks will be coming to just share some information about how other states deal with analyzing and evaluating tax expenditures and, lessons that we may learn from that. After that presentation, we need to kind of shift into coming to some agreements on points of procedure to guide the work of the commission and the work of our staff, especially between our commission hearings, because we have there's a lot of work to be done. So, those decision items are going to include logistics like the schedule of review, which Chair Marquardt was just referring to. We're going to need to do some prioritization of the tax provisions for review. And you can expect just more communication and details as we finalize that agenda and sort of come to those decision points. I just wanted to mention that the meeting documents from today, including the presentations, can be found on the Tax Expenditure Review Commission meeting webpage. So I know I'm going to be going and reviewing some of those presentations and urge other members to do so. With no further business before us, this meeting of the Tax Expenditure Review Commission is adjourned. Thank you so much, everyone, for being here today.